This line chart tracks Bitcoin over the past year. Last October, the trend was unstoppable, peaking at an all-time high over $126,000. But suddenly, the line plunges, breaking through the $60,000 floor. Despite a slight recovery to $63,000, massive losses are locked in. When a drop like this happens, everyday traders tend to look inward. They scan the crypto industry feeds, assuming a protocol got hacked or a major exchange updated its terms of service. That assumes the market is a closed loop. In reality, we have to track liquidity, the actual cash moving through the system. When billions of dollars weave Bitcoin, that capital doesn't vanish into thin air. It flows outward, seeking better returns elsewhere. To figure out where all that money went, we have to pull back our focus. The shrinking crypto portfolio is actually the result of massive external shocks dictating the global flow of money. First, let's look at the push factors. These are large-scale global events that create panic, forcing risk-averse investors to pull their money out of volatile assets. Domestically, the latest data shows U.S. inflation hitting a 3-year high. Combine that with a surprisingly strong national jobs report, and you get a volatile mix for financial markets. Traders read those metrics as a warning sign. Strong employment and high inflation give the Federal Reserve the perfect justification to raise interest rates. When the Fed raises rates, borrowing money gets more expensive, but the payout on ultra-safe investments like government bonds goes up. Investors immediately dump unpredictable assets like cryptocurrency in favor of those guaranteed returns. Overseas, rising geopolitical tensions and military conflict in Iran are creating a secondary wave of panic. Instability in the Middle East consistently drives oil prices higher while dragging down broader asset classes, including stocks and gold. When large institutional holders like Strategy react to this by selling off chunks of their Bitcoin reserves, everyday retail traders panic and follow suit. Domestic monetary policy and foreign military conflicts are colliding. Together, they create immense pressure, pushing billions of dollars straight out of the crypto ecosystem. But fear only accounts for half of the capital drain. That fleeing money is also being aggressively pulled toward highly lucrative new opportunities. The immediate catalyst is arriving this Friday. SpaceX is set to launch a massive initial public offering, allowing the public to buy shares of the aerospace company for the very first time. This diagram illustrates capital rotation. Investors intentionally cash out of easily sellable assets like Bitcoin to have dry powder for the IPO. This massive offering acts as a giant vacuum, siphoning liquidity away from the cryptocurrency sector. Bitcoin is trapped in a brutal financial tug-of-war. It is simultaneously losing investors to the strict safety of high interest rates and the aggressive allure of traditional tech IPOs. The crypto industry knows exactly how vulnerable it is to these swings. Leaders recognize that without structural, legally binding rules, they have no way to stop this endless bleeding of capital every time a global shock hits. In response, a massive coalition has formed. Over 200 advocacy organizations and major firms, including heavyweights like Coinbase, Ripple, Andreessen Horowitz, and Circle, are now pooling their resources to push back. Their proposed solution is sitting in Washington. It is a market structure bill known as the Clarity Act, and it is designed to act as an economic anchor to hold the industry steady. We can break the bill down into a few key provisions. First, it officially designates the Commodities and Futures Trading Commission as the primary agency overseeing crypto markets. Second, it legally protects a user's right to self-custody, meaning individuals can hold their own digital assets without relying on a third-party bank. Finally, the bill creates strict legal definitions for technical terms like mature blockchain and digital commodity, ensuring the asset class is recognized by the full weight of the U.S. government. By establishing these hard rules, the Clarity Act assures large institutional investors that their holdings are legally secure, which stops them from panic selling the moment an economic crisis makes headlines. The problem is the ticking clock on the Senate floor. Lawmakers are facing a massive legislative backlog, and the coalition is heavily pressuring Senate Majority Leader Chuck Schumer to schedule a floor vote before the rapidly approaching summer break. This chart reflects current prediction markets, where traders give the bill a strong 68% chance of securing the 60-plus votes it needs to pass the Senate by the end of the year. But that optimism clashes sharply with the political reality on the ground. Key proponents of the bill, like Treasury Secretary Scott Bessent and Senator Cynthia Lummis, are urging their colleagues to act immediately. Senator Lummis has issued a very specific, grim warning. With the current political calendar, if this legislation misses the immediate window before the summer recess, the next viable chance to pass it likely won't arrive until 2030. If the Clarity Act fails, the industry remains entirely exposed. It means the crypto market will spend the rest of the decade completely defenseless against every shifting interest rate, foreign conflict, and rival IPO that threatens to drain its capital away.